Hi, there's been a lot of talk lately about silver getting hit, gold losing some momentum, and the futures market looking weaker right when people expected it to look stronger. So, in this video, we're going to separate fear from facts, and you are going to walk away understanding the one thing that could matter more than Fed rate cuts for gold and silver. Today is Saturday, May 2nd, New York time, so comment below what day and date you're watching from because I want to see how many people are tracking this move in real time. And before we go any further, if you value this kind of breakdown, support the channel by subscribing and commenting John A.G. Best. It helps this work reach the right people and tells me you want more clean market analysis like this. So here's the setup. Everybody is staring at the Fed. Everybody is waiting for the next rate cut. Everybody is asking, okay, when do they finally blink? But what if that is not the main switch anymore? What if gold and silver do not need the Fed to rescue the trade? What if the bigger driver is inflation moving faster than policy can respond? That is what we need to unpack. First, let's talk about gold, because gold has been acting like the adult in the room even when the short-term chart looks messy. Based on recently published market numbers, the mainstream forecast range for gold has moved sharply higher, and some serious estimates now sit around the high 4,000 area for this year. Other more aggressive views are looking toward the low 6,000 area, maybe even higher, if this bull cycle keeps stretching. Now, do I know that happens? No, nobody knows that. But the point is not the exact target. The point is that the ceiling keeps getting lifted, and when the ceiling keeps moving up, that tells you the old model is not working the way it used to. For years, gold was treated like a sleepy insurance policy. You owned it, maybe it did nothing for a while, and people rolled their eyes. But now central banks are still buying meaningful amounts of gold, even at record prices. Gold-backed investment demand has also come back into the conversation. Jewelry demand is weaker because prices are high, but reserve demand is still alive. That is a completely different market personality. And that matters, because central banks do not buy gold because it is shiny. They buy it because reserves are about trust. Gold has no issuer, no board meeting, no election cycle, no promise printed on paper. In a world where debt, sanctions risk, energy risk, and currency politics are all part of the same conversation, that feature becomes more valuable. Now, silver is different. Silver is not calm. Silver is emotional. Silver can make you feel brilliant in the morning and then make you question your whole thesis before lunch. It has industrial demand, investment demand, solar demand, retail demand, and paper market pressure all fighting at the same time. So when silver gets hit, the first question is always the same. Was that real selling or was that paper pressure? And that takes us to the futures market. There has been a lot of noise about open interest being extremely low. On the surface, that sounds scary. If fewer traders are rolling contracts forward, if participation is shrinking, and if physical users are stepping away, it can look like confidence is leaking out of the system. However, we have to be careful. Low open interest by itself does not automatically mean an exchange is about to fail. It can mean speculators left. It can mean margin got expensive. It can mean volatility scared people out. It can mean traders are waiting for a cleaner setup. So if somebody takes one chart and says, there it is, the whole system breaks tomorrow, I would slow down. Stress is not the same as collapse. But stress is still worth watching. Here is the distinction. If managed money leaves, that may just be positioning. If short-term traders leave, that may just be fear. But if the physical side of the market reduces its footprint, that becomes more important. Producers, merchants, processors, and users are not tourists. These are people who use futures for hedging, inventory planning, financing, and risk control. So if that group becomes less active, it does not prove default, but it does raise a serious question. And the question is this: does the market still trust the paper mechanism as a reliable hedge against real-world metal needs? That is a big question. Now, based on the public structure of the commitment reports, those physical categories are not just some random bucket. They represent commercial users and suppliers who can have long or short exposure depending on what they are trying to hedge. So when people talk about physical players leaving, the correct response is not panic. The correct response is, okay, show me the trend, show me the contract mix, show me the delivery behavior, and show me whether it is temporary or structural. That is how we should think. Same thing with paper volume. On one of the recent ugly silver days, the paper market traded an enormous amount of silver exposure compared with annual mine supply. And yes, when you hear that, it sounds ridiculous. It sounds like a tiny physical market is being pushed around by a giant financial shadow. But let's take it apart. A futures trade is not the same as a bar leaving a vault. A delivery notice is not always the same as metal leaving the warehouse. A contract changing hands does not mean every ounce physically moved. So the paper market can look massive compared with the physical market without every paper ounce being a missing physical ounce. That does not mean the paper market is innocent. It just means we need to understand the machine before we declare it dead. Now here is where the silver story actually gets more interesting. Fresh silver market projections still show a supply deficit backdrop, but not in the simple way many people want to hear. Industrial fabrication is expected to soften a little because high prices are forcing thrift and substitution in solar. Jewelry and silverware demand are also under pressure in price-sensitive markets. But physical investment demand is expected to rise strongly, and total supply is only expected to grow modestly. So the bullish silver case is not just everything is exploding higher everywhere. That is too lazy. The real case is more nuanced. High prices are destroying some demand, yes, but uncertainty is also bringing investors back. Solar is still huge, but manufacturers are using less silver per panel. Mine supply is improving, but not enough to make the market feel easy. That is the kind of mixed setup that creates volatility, and silver loves volatility. Now let's zoom out, because the bigger story is not one silver chart. The bigger story is real rates. The common argument is simple. If the Fed cuts rates, real yields fall, and gold and silver go up. Fine. That makes sense. Lower rates reduce the reward for sitting in cash and bonds, so non-yielding metals look better by comparison. But there are two ways to create negative real rates. Rates can fall, or inflation can rise faster than rates. Everybody is staring at the first door. Almost nobody is watching the second door closely enough. The Fed just held rates in the mid-threes, while also saying inflation is elevated, and global energy prices are part of the pressure. It also pointed to Middle East developments as a source of high uncertainty. That is not a clean environment for easy rate cuts. That is a box. Growth is still okay, jobs are not falling apart, but inflation pressure is back in the room. So if you are waiting for a simple dovish pivot, you may be waiting for the wrong thing. The latest inflation data showed consumer prices rising in the low threes from a year earlier, with energy up much more than the headline. Gasoline, electricity, natural gas, travel costs, insurance, and shelter all matter because they feed into household psychology. And once households start believing inflation is sticky, the Fed has a much harder job. That is the problem. The Fed can cut rates only so far before it risks looking reckless. Inflation, on the other hand, can surprise in waves. Energy first, then transportation, then food, then wages, then insurance, then rents. It does not all hit at once, and it does not hit evenly. But once those second-round effects start moving, inflation becomes harder to talk down. And no, I am not cheering for that. I do not want food prices to spike. I do not want families squeezed. I do not want small businesses paying more for fuel, rent, labor, insurance, and financing all at the same time. A bullish metals thesis can come from a painful economic setup. Both things can be true. But as investors, we have to look at the structure honestly. The United States is running very large deficits, and official budget projections still show a deficit near the $2 trillion area for this fiscal year, with rising interest costs driving a lot of the long-term pressure. Public debt is also moving around levels that make the fiscal conversation uncomfortable. So higher rates are not just a monetary policy tool anymore. They are a government financing problem. That is the trap. Back in the old inflation fight, the Fed could slam rates much higher, because the debt structure was very different. Today, if rates go too high and stay too high, the government's own interest bill starts eating more oxygen. So the Fed can talk tough, and sometimes it may even act tough, but the system underneath it is more sensitive than people admit. That is why inflation may matter more than rate cuts. If inflation runs hotter while rates stay capped by debt pressure, real rates can become more negative without the Fed doing some dramatic pivot. That is the quiet door. That is the door the market may not be pricing correctly. And once that clicks, the gold and silver discussion changes. People stop asking, when will the Fed help metals? They start asking what happens if inflation helps metals before the Fed even gets permission to cut. That is a very different question. Now, we need a counterpoint because this is important. Inflation alone does not guarantee gold and silver go straight up. If inflation rises and the market believes the Fed will crush it, metals can get hit. If the dollar rallies, metals can get hit. If investors need cash, metals can get sold. So please do not turn this into a cartoon where inflation equals instant silver moonshot. Markets are messier than that. But if inflation rises while the Fed looks constrained, and if debt makes aggressive rate hikes politically and financially painful, then the real rate argument becomes much stronger. That is the setup worth watching. So when silver bounces from a level traders are watching, I do not immediately call victory. I say, okay, buyers defended a zone. Now can it hold? Can momentum return? Can investment demand absorb weak hands? Can the physical market keep tightening beneath the surface? That is the real test. If you're successful, share your success story in the comments so others can stay motivated. And let me say this clearly. I do not think we should be rooting for the futures market to break. I understand why people say it. I understand the frustration. But if the pricing system breaks, you may not get the clean moonshot people imagine. You may get trading halts, rule changes, forced settlements, political attention, reporting requirements, and confusion about what the real price even is. That is not freedom. That is chaos. What we should want is a fair repricing through functioning markets, more respect for physical scarcity, more recognition of debt risk, more attention on the difference between a claim on metal and actual metal. That is the healthier version. So here is my view. Gold is still the cleaner monetary signal. Silver is the higher volatility amplifier. Gold tells you confidence is shifting. Silver tells you when speculation and physical tightness collide. If the macro setup keeps pointing towards sticky inflation, large deficits, energy uncertainty, and constrained policy, both metals have a real reason to stay in the conversation. Not every day, not in a straight line. But structurally, the story is not dead. The biggest mistake right now would be thinking metals need one single trigger. They do not. They have multiple triggers, building at the same time. Central bank gold demand, retail silver demand, energy-driven inflation pressure, debt sustainability concerns, futures market skepticism, industrial silver use, and the possibility that real rates fall because inflation rises, not because the Fed cuts. That is a powerful mix. So the question for you is this. Do you think the next big move in gold and silver comes from Fed rate cuts or from inflation forcing real rates lower without waiting for permission? Drop that in the comments because I want to see where people stand. And one more thing. The strongest moves usually begin when the picture still looks confusing. The chart looks messy. The headlines argue with each other, people get tired. Then months later, everyone says it was obvious. Well, it usually was not obvious in real time. It was uncomfortable. That is where we are, so stay calm. Do your research. Do not buy panic. Do not buy fantasy either. Watch the data. Watch real rates. Watch energy. Watch open interest. Watch physical investment demand. Watch whether silver keeps attracting buyers after every shakeout. Because if the thesis is right, you will not need fear to hold it. You will need patience. And that patience is not passive. It means knowing what would prove you wrong. If inflation cools, energy calms down, deficits stop widening, real yields rise, and physical demand fades, then you reassess. You do not marry a thesis just because it sounds exciting. But if the opposite happens, if inflation stays stubborn, if debt keeps climbing, if central banks keep adding gold, and if silver investors return while supply remains tight, then the market may be telling you, the next phase is not about one announcement. It is about pressure building across the whole system. That is why I keep watching this setup closely. And when pressure meets a thin, emotional silver market, moves can happen faster than people who waited for certainty really ever expected. This is for education and market discussion only. It is not financial advice, and I am not telling you what to buy, sell, or hold. Please check the numbers yourself, understand your own risk, and make decisions that fit your life, not someone else's excitement.